In the year 2000, Enron reported $101 billion in revenues. Fortune magazine had named it America's most innovative company for 6 consecutive years. Its stock had risen 89% in a single year. 18 months later, it was the largest corporate bankruptcy in American history. But the Enron collapse is not a story about one fraudulent company. It is a story about a system, auditors, analysts, regulators, and investors, that was structurally arranged to believe the story, because believing the story was profitable. In the next 14 minutes, I'm going to show you the exact mechanism that made Enron possible. Not the fraud itself, but the architecture underneath it. And once you see it, you'll recognize it immediately the next time it appears. We decode the systems most people never see, until it's too late. Why they rise, why they fail, and what the patterns reveal about strategy and power. This is Second Move, the logic behind the outcome. Subscribe to see 3 steps ahead. Enron started as a natural gas pipeline company. It was formed in 1985 through a merger of 2 regional gas utilities. Pipes in the ground, contracts for delivery, straightforward industrial business. That business was not particularly exciting. It had regulated returns, limited growth, and no particular reason to command a premium valuation. So Enron's leadership, under Jeffrey Skilling, who joined in 1990, decided to become something different. They decided Enron was no longer an energy company. It was a trading company, a financial services company, a technology company, a market maker for anything. Electricity, bandwidth, weather derivatives, that could be turned into a contract and traded. This reframing was not accidental. It was a deliberate strategy to escape the valuation logic of a utility and enter the valuation logic of a financial institution. Utilities trade at 10 to 12 times earnings. Technology companies in 2000 traded at 60, 80, sometimes 100 times earnings. The difference between those 2 valuations, that gap, was the business model. To sustain the new valuation, Enron needed a new accounting method. In 1991, it received SEC approval to use mark-to-market accounting for its trading operations. Mark-to-market means this. When Enron signed a long-term energy supply contract, say a 20-year deal to supply electricity, it was permitted to book the entire estimated future profit from that contract as revenue in the current quarter, not when the money arrived, not when the service was delivered. On the day the contract was signed, this created a structural pressure that Enron could never escape. To report growing revenues each quarter, Enron needed to sign larger and larger contracts. Because the moment a contract was signed and booked, it could never appear on the income statement again. It was consumed, used up. The machine required permanent acceleration. To understand what this acceleration looked like in practice, consider a single quarter. Enron signs a 20-year electricity supply contract. It immediately books the estimated profit from that entire contract as current revenue. Let's say the contract is worth $200 million in projected future profit. That $200 million appears in this quarter's earnings report. Next quarter, that contract is gone. It has been consumed. Enron needs to find more than $200 million in new contract value just to report flat revenue. To report growth, which is what the stock price required, it needs significantly more. And then the quarter after that, and the quarter after that. The pressure compounded with every quarter. Skilling had committed Enron to a 15% annual earnings growth target to sustain the stock price. To deliver 15% growth using mark-to-market revenues, Enron needed to sign not just more contracts, but contracts with larger and larger estimated future values. The quality of those contracts was secondary. What mattered was the size of the number that could be booked today. This created an obvious problem. When the actual cash from those long-term contracts started arriving, or failing to arrive, the difference between the projected revenue and actual revenue had to go somewhere. It went into the SPEs. But mark-to-market was only half the mechanism. The second half was what Enron called special purpose entities. SPEs were separate legal entities, companies created by Enron, funded with Enron stock, whose purpose was to absorb the debts and failing assets that Enron did not want appearing on its balance sheet. When one of Enron's ventures performed poorly, and many of them did, The losses were transferred into an SPE, off the balance sheet, out of the income statement, invisible to investors. The SPEs were named after Star Wars characters: Jedi, Chuko, Raptor. This is sometimes described as creative accounting. It is worth being precise about what it actually was: the systematic concealment of the company's true financial condition from the people who owned it. Arthur Andersen, one of the 5 largest accounting firms in the world, signed off on every set of accounts, every year, for a decade. The question that was never satisfactorily answered during the congressional hearings or at any point in the subsequent legal proceedings is how Arthur Andersen signed off on accounts that concealed the SPE structures for so long. The technical answer is that the SPEs were technically legal under accounting rules at the time. The rules required SPEs to have at least 3% of their equity from independent outside investors. Several of Enron's SPEs failed even this test, but Andersen continued to certify. The deeper answer is simpler. Arthur Andersen earned $52 million from Enron in the year 2000 alone. Of that, $27 million was from consulting work. The audit relationship was the entry point. The consulting work was the profit. An auditor who qualifies the accounts, who raises a formal objection, who insists on disclosures that Enron doesn't want to make, risks losing both the audit and the consulting relationship. The rational economic decision for an individual partner at Arthur Andersen looking at the Enron account was to find a technical basis for approval and move on. Not because they were corrupt, not because they were incompetent, because the structure of the relationship made honesty expensive and compliance cheap. That structural condition was not unique to Arthur Andersen and Enron. It was the standard operating model of the entire auditing industry. Sarbanes-Oxley attempted to address it, but the fundamental problem, that auditors are paid by the companies they audit, was not resolved. It was regulated at the edges. Here is the failure point. The entire structure, the mark-to-market revenues, the SPE debt concealment, the inflated valuation, required one thing to continue functioning. The confidence of the people looking at it had to hold. This is the specific property that makes Enron different from Lehman Brothers. Lehman's machine required house prices to keep rising. That was a bet on an external market condition. Enron's machine required something more fragile. It required belief. In March 2001, a journalist named Bethany McLean published a short article in Fortune magazine with one simple question: how does Enron actually make its money? She had read the SEC filings. She could not find in any of the public documents a clear explanation of where the profits came from. Enron's response was to call her editor, fly her to Houston, and have 3 senior executives, including Skilling, spend hours explaining that she simply didn't understand the business. The article ran anyway. Analysts dismissed it. The stock barely moved. But something had changed. A question had been asked publicly. And once a question like that exists, the system that depends on no one asking it has already begun to fail. The mechanism of that failure was specific. Before McLean's article, every institution evaluating Enron had the same information and was making the same calculation. The risk of challenging the Enron narrative was high. The cost of maintaining it was low. After the article, the calculation changed. Not because new information had emerged, but because the possibility of public embarrassment had. If an analyst had maintained a buy rating on Enron in late 2001 and Enron subsequently collapsed, they had published their skepticism in Fortune magazine months earlier. That analyst would face questions. Why did you maintain coverage? What did you miss? The reputational calculus had shifted. It is worth being precise about what this means. The article did not provide new evidence of fraud. It simply created a public record that the question existed. That one journalist had read the SEC filings and found the answer unclear, and that public record changed the incentives for everyone else looking at Enron. Institutions that had previously concluded that the risk of questioning Enron outweighed the benefit quietly began to reweigh that calculation. The stock began to move, not because the underlying reality had changed, but because the social permission to acknowledge that reality had changed. This is how confidence-based systems fail, not all at once. First, the permission to question, then the questions, then the cascade. By August 2001, Skilling had resigned, officially for personal reasons. He had been CEO for 6 months. In October, Enron announced a $618 million third-quarter loss and a $1.2 billion reduction in shareholder equity connected to the SPs. The SEC opened an investigation. The stock, which had traded at $90 in August 2000, fell below $1 by November 2001. On December 2, 2001, Enron filed for bankruptcy. 20,000 Enron employees lost their jobs. Most had a significant portion of their retirement savings in Enron stock they had been actively encouraged to hold even as senior executives were selling. The pension funds of school teachers and municipal workers across America held Enron shares rated AAA by the same agencies that had been watching the SPEs for years. Arthur Andersen was indicted for obstruction of justice. The firm collapsed within months. 85,000 Arthur Andersen employees lost their jobs. Most of them had nothing to do with the Enron account. This is a pattern in systemic failure that is rarely discussed. When a large institution collapses, whether through fraud, through structural failure, or through a confidence crisis, the people who bear the heaviest cost are almost never the architects of the problem. The Enron executives who designed the SPE structures negotiated departure packages worth tens of millions of dollars. Skilling had sold $66 million in Enron stock before the collapse. The Arthur Andersen partners who signed off on the Enron accounts were a small number of people, most of whom retained their professional standing long after the firm collapsed. The 85,000 Arthur Andersen employees who had nothing to do with Enron, who worked in offices in London, in Sydney, and Frankfurt, on accounts that have never heard of special purpose entities, lost their jobs within months of the bankruptcy filing, because Arthur Andersen's business model depended on a single asset: the credibility of the Andersen name. Once that credibility was gone, there was no business. This is a specific type of structural vulnerability that is almost impossible to see from inside the institution. When your core asset is not a product, not a patent, not a physical asset, but a reputation, you are one scandal away from nothing. The firm survived for 89 years. It survived 6 months after the Enron indictment. The congressional hearings that followed produced extraordinary testimony. Skilling received a 24-year prison sentence, later reduced to 14. Lay died before sentencing. Fasto served 6 years. And the Sarbanes-Oxley Act, passed in 2002, was held up as proof that the system had corrected itself. It had not corrected the structural condition. It had responded to the visible symptom. Here is the pattern. Enron is taught as a story about 2 men, Skilling and Lay, and the culture of arrogance they created. That story is accurate, but it is not the lesson. The deeper structure is this. Enron existed because every institution whose job it was to evaluate it had a financial incentive to believe the story rather than examine it. Analysts who issued buy ratings got access. Those who questioned the stock lost it. Arthur Andersen earned $52 million from Enron in 2000 alone. The consulting work depended on the audit relationship. Rating agencies were paid by Enron to rate Enron's debt. They maintained investment-grade ratings until 4 days before the bankruptcy. This is not a story about individuals failing to do their jobs. It is a story about a system where doing your job, properly, honestly, at risk to the relationship, was economically irrational. That structural condition did not end with Enron. It was present in every major financial institution that received AAA ratings on mortgage-backed securities in 2006. It was present in the venture capital ecosystem that valued WeWork at $47 billion. It is present today in every industry where the evaluators are paid by the evaluated. And it will be present in the next collapse, whatever form that takes. Because this structural condition has a specific property that makes it self-perpetuating. The institutions that benefit from not examining too closely are also the institutions with the resources and the political influence to shape the regulatory response when things go wrong. After Enron, the regulatory response was Sarbanes-Oxley. It introduced new requirements for CEO certification of financial statements, new restrictions on auditor consulting relationships, and new penalties for deliberate misrepresentation. These were real changes. They were not trivial, but the fundamental structure, rating agencies paid by issuers, auditors paid by the companies they audit, analysts dependent on access maintained by favorable coverage, was not broken. It was adjusted at the margins. And then, 7 years later, the same structural condition produced the 2008 financial crisis. AAA ratings on mortgage products that the rating agency's own analysts privately doubted. Auditors signing off on balance sheets that obscured the true extent of leverage. Analysts maintaining buy ratings because the banking relationships depended on it. The names changed. The structure did not. This is not cynicism. It is the predictable outcome of a system where the incentives to look carefully and the incentives to look away are not equally distributed. The people who gain from the story continuing always have more to lose from asking the question, and more resources to ensure the question is not asked, than the people who might benefit from an honest answer. That asymmetry is the architecture of the failure. Not the greed, not the fraud, not the individual bad actor. The asymmetry. The fraud is never the failure point. The failure point is always the arrangement that made the fraud rational. Enron was never an energy company. It was a confidence game. And the confidence lasted exactly as long as the system had an incentive to maintain it. If you want to understand the next system built on confidence rather than substance, that video is up here. Second move. Everyone plays the first move. Subscribe to Second Move.